for the introduction, and good afternoon, everybody. It's great to be here today. I wanted to talk about profiting in down markets. We've had a pretty long bull run here for the last 10 years or so, but we're currently facing a down market, and we wanted to discuss the strategies we use in a down market. Today we'll look at the best stocks and ETFs to short if you want to take short positions. We'll look at a system for selecting bearish trades, and we want to limit our risk on bearish trades to the cost of the trade. That's very important when you're short. You don't want to just be short a stock or short an option because you face unlimited risk if the stock continues to increase in price. So that's a very important part of short positions, is you want to make sure you use limited risk short positions and you're only risking the cost of the trade. And we'll have a Q&A session at the end. I'd be glad to answer any questions. So the strategies we'll look at today are put option purchases, bearish debit spreads. We'll look at our profit guard strategy and married puts. And we're going to look at several ways that can increase your percentage of winning trades. And a higher percentage of winning trades can give you the discipline needed to become a successful trader. So over the years we've developed certain systems that allow us to increase our percentage of winning trades, and that helps a lot with our discipline that we maintain to stay consistently profitable in any kind of market. And I'll show you a snapshot of our portfolio, brokerage account portfolio report with $901,000 in open trade profits for the profit guard strategy. And this report will list the stocks and options that we own, the current price, the profit, and the percent return. So we are making money in these down markets. Here's a snapshot, and we'll look at this in a little more detail later on, but this is open trade profits for the profit guard strategy, where we list the stock or the option, the total gain in this column, and the percent return. And I also want to take a look back. We've had our advisory service in place for about 20 years now, and we started it right at the beginning of the dot-com crash. So you can see those years the advisory service was profitable. Of course, we had the market meltdown in 2007 and 2008, and these are the yearly profit results for our advisory service in this column here. And you can see we were profitable during the market meltdown. 2011, we had that 18% correction. We were profitable. And then in 2018, we had two major corrections, and we were profitable in 2018. So I just wanted to show you that these strategies that we're going to look at today did get us through these bear markets and market corrections with profits. And all the strategies we'll discuss today, as I mentioned, are limited risk strategies, and you can't lose more than the cost of the trade. Of course, if you short a stock or a naked call option, you incur unlimited risk, as you can lose more money than you invest. And this can result in a margin call, so we don't want to go down that path. And the best stocks to short, we found through experience, are growth stocks with little or no earnings. Those are the best candidates for short positions, obviously, in a market downturn. So we like to focus on those growth stocks with high PE ratios, which normally decline the most during bear markets, and you can profit with short positions. So let's take a look at a couple examples of high PE stocks. This is a daily price chart here of Spotify, and Spotify has no earnings. Of course, it's been selling off in this recent downturn. You can see it went from about $200 a share down to about $115. Here's another example, Netflix, a high PE stock, PE of 90, went from about $410 a share to $250 a share. So these are just examples of high PE stocks. This is Alibaba. You can see that went from about $210 down to $135. So those are the stocks that you want to focus on in a market downturn. So let's talk about our first strategy, and that's a put option purchase. A put option purchase, of course, is a bearish strategy, as the value of a put option increases as the underlying stock or ETF decreases in price. Your risk is limited to the cost of the put. This is a much lower risk strategy than shorting a stock, which incurs unlimited risk if the stock continues to increase in price. And normally a margin account is not required for put option purchases. And we normally initiate put option purchases with about 1 to 3 months until expiration, and most put options cost between $500 to $1,500. They could be a little more expensive on those really high-priced stocks, but generally somewhere in the $500 to $1,500 range. And you can trade a portfolio of put options in a $5,000 trading account. So we're going to look at the selection process we go through to select a bearish trade. And we have a 3-step process to select bearish trades, and we use the 10-month simple moving average trend following system for selecting stocks for put option purchases. So with this 10-month simple moving average, we want to identify a stock that's moving down in price, and then we can profit by purchasing a put option. So step 1 is we determine the price trend of a stock using the 10-month simple moving average system. Step 2 is we confirm the price trend using on-balance volume. And the third step is we use the 1% rule to select the put option strike price for a higher percentage of winning trades. Okay, let's look at step 1, determining the price trend of a stock using the 10-month simple moving average system. And we use the 10-month average to identify the price trend of a stock, and that allows us to trade with the trend instead of trying to predict the future price movement of a stock. The 1-month price of a stock in relation to its 10-month simple moving average is a great way to identify the major trend of a stock. Now, you may recall from previous webinars for bullish trades, we use the shorter term 50 and 100-day EMA system for selecting trades to purchase call options, but we found the longer term 10-month simple moving average is more profitable for selecting bearish trades. The 10-month simple moving average has fewer whipsaw trades that occur when counter trend rallies stop you out of your short position. So if you're going to take a short position, we like to use a longer term trend following system, and the 10-month simple moving average is a great way to identify the longer term trend if you're going to be taking a short position. So if the 1-month price of a stock is above the 10-month simple moving average, then a bullish trend is indicated, and if the 1-month price is below the 10-month simple moving average, a bearish trend is indicated. So for put option purchases, we only want to focus on stocks or ETFs in a price downtrend with the 1-month price below the 10-month simple moving average. And we only look at the 1-month price of a stock in relation to the 10-month simple moving average, and we only look at it on the last trading day of the month, and we ignore all the other trading days. So it only takes a few minutes a month to check that price trend to see if that stock is in a downtrend. And as we mentioned, if the 1-month price of a stock is below the 10-month simple moving average on the last trading day of the month, then that stock is on a sell signal. So the price movement of a stock reflects all of the known information about a company. So we use that 10-month simple moving average system to measure that price movement of a stock. So all the known information about a company is reflected in that 10-month simple moving average. So if you can quantitatively measure that price movement, then you can benefit from trading with the trend. And you can download the 1-month, 10-month simple moving average from pricecharts.com with the basic subscription. Let's look at an example of a sell signal. This is for the social media ETF, symbol SOCL, and on this price chart, this black and red line right here, that's the 1-month price of a stock. So you can see in September the ETF was trading here, in October the ETF was trading here. So this is the 1-month price of that ETF. And this blue line is the 10-month simple moving average. So we can see that the social media ETF was on a buy signal, but then it crossed below that 10-month simple moving average in July. So at that point it was on a sell signal, and you want to consider taking bearish trades with the social media ETF. So right in here, 1-month price crossed below the 10-month simple moving average. And you can see it fell from about $33 a share down to about $27 a share since the sell signal. So we want to buy put options on stocks or ETFs that are on a 10-month SMA system sell signal. And when you use this trend following system, we're using a system instead of using emotional decision making, and we've been using trend following successfully for more than 30 years, and the trend following worked well in the 2002 and 2008 bear markets, as you could see from our advisory service results when we had short positions during down markets. And a trend following system also eliminates emotional decision making, and instead it gives us the discipline we need to be successful option traders. Okay, so step one is we identify the price trend. We want to make sure the stock is in a downtrend on a sell signal if we're going to take a bearish position. And step two is we want to confirm the price trend using on-balance volume line or the new 52-week low list. So once we determine a stock is on a sell signal, we want to confirm that price trend. An on-balance volume measures volume flow with a single easy-to-read line, and volume flow always precedes price movement and helps sustain the price trend. And the way the on-balance volume line is calculated is when a stock closes up for the day, volume is added to the line, and when a stock closes down, volume is subtracted from the line. So a cumulative total of these additions and subtractions form the OBV line. So let's look at an example of it. This is the daily price chart of the social media ETF, these vertical red and black lines right here, and below here is the on-balance volume, and you can see that the on-balance volume has been in a steady decline. So the line is sloping down. So if we're going to take a short position, we want to confirm the price trend and make sure the OBV line is sloping down. So when the OBV line is sloping down, volume is heavier on days that the stock closes down, and volume is lighter on the days a stock closes up. So it's an indication that the selling pressure is exceeding the buying pressure, and it confirms the price downtrend. And you can also download the OBV line from stockcharts.com. And we simply use the default parameters for the OBV line. So the default parameters on the website is what we use for the on-balance volume. And we also like to confirm the price trend by the new 52-week low list. So we found that stocks that are making a new 52-week low are in a powerful downtrend, and they tend to continue their price downtrend. So that's a second way to confirm the price downtrend, is to see if the stock is making a series of new 52-week lows. And you can see with the social media ETF that this is a one-year daily price chart of the social media. You can see that it's making a series of new 52-week lows. And you can download the new 52-week low list from barchart.com. You just click lows, and it'll list the 52-week new lows. And this list is also a good starting point if you're going to be looking for bearish trades. You want to look at the list of stocks that are making new 52-week lows as candidates for short positions.